Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. You can join Brian Curtis and myself for the stories making news and moving markets in the APAC region. You can subscribe to the show anywhere you get your podcast and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. Jason Schenker, he is with us. Jason is the president of Prestige Economics. He joins us from our studios here in New York City. Good to see you. Thanks for stopping by.
Thanks, Doug.
Can we start with the PPI data? I'd like to get your take on what you make of this report.
Yeah, absolutely, Doug. Well, I think there's a couple things. You know, while that year-on-year rate slowed significantly to that 2.2%, I think there are a couple things in the report that are disconcerting for me if we're looking for easing inflation. If you look at the core PPI, where that's excluding food, energy, and trade, that actually accelerated modestly to 3.3% from 3.2%. We look at goods PPI, that accelerated from 1% to 1.7%. If we look at the intermediate stages of processed and unprocessed goods, all of those major categories were up month on month and up year on year. And that plus the month on month increases of both the total and the core PPI make me concerned about what we're going to see in tomorrow's CPI report, where I think there's a lot of hope for easing inflation so the Fed can do quick cuts, deep cuts. And, you know, markets might be cruising for a bruising if inflation doesn't ease.
But if it's stable right now, if we can agree to that much, and we're seeing a deterioration in the labor market, maybe the focus in terms of the mandate shifts from the inflation side to the labor market side, and the Fed goes ahead to kind of get out in front of what could be meaningful contraction in the economy.
I mean, it might be, but if we look at the labor market data, the latest jobs report, the total number of non-farm payrolls is now at an all-time record high. The labor force size is at an all-time record high. The reason the unemployment rate went up isn't because the number of employed people went down in the latest month. It's just because the number of unemployed people went up faster than the number of employed people. Like both of those series increased for the month. So, you know, to be at a record high of payrolls and think it's catastrophic in a month that was positive, but not significantly positive, and with still almost 8.2 million open jobs in the JOLTS data, jobless claims that are only about 1.1% of the total labor force, show me the horrible justification for an intermediate emergency rate cut. I just don't see it.
It was a disappointing read, the July figure, right? And that triggered kind of ructions in the markets globally and a big unwind in the carry trade.
Yep.
It really is instructive about the degree to leverage that we have seen in the system for some time. First of all, as it relates to the yen carry trade, are we through with this now?
I don't necessarily think we are because, you know, we could see some further moves here, right? This can be a very jerky process, and I think we're going to see various surprises going forward. I don't necessarily think all the data is going to come out in a clean way. And if we see inflation data not ease in a significant way, again, like Fed Chair Powell said at the July 31st decision, not that long ago, right? They're looking at the totality of the data. And if inflation doesn't ease that much, the Fed's hands are tied. And if the Fed's not going to be able to ease as significantly as some are hoping, 50 basis point cuts in September, emergency cuts before then, if these things don't happen and more people are excited that they will happen, you know, expectations minus reality equals disappointment. And then that could cause more volatility in the FX markets and equities as well.
What about the bond market? Does the bond market have it wrong with rates coming down as much as we have seen?
For the bond market, it's very interesting because whether you believe the Fed won't be able to cut rates that much, which means maybe growth slows a lot more, well, that's bullish for bonds, right? Bond prices up, yields down. Or whether you believe, all right, the Fed's going to be able to cut more quickly, again, you get bond yields down, prices up, right? So for bonds and for the dollar, directionally, there's actually more bias that maybe you can make cases in either scenario, rapid significant rate cuts or slower growth in order to get those rate cuts, bond yields and dollar down. You can make those arguments. But for industrial commodities or for equities, it's a different story, because if it takes longer to get to the cuts and growth hurts more first, that can have a much more negative impact on equities and industrial metals in the short term.
What are you hearing from your clients these days? What are they telling you?
Yeah, what I'm hearing, most of my clients are corporate. They work in the physical part of the economy. You know, we see, especially on the manufacturing side, material handling, other physical industries, we see new orders are down. Shipments are still pretty good because companies had big backlogs in the wake of COVID. They're still burning off. So unfilled orders are falling, inventories are falling. Shipments are still solid, but new orders have been falling a lot. By the way, for GDP standpoint, shipments, finished goods, that's what's important for GDP. But new orders are under pressure, which means looking at what will next year's shipments be, that's important for GDP growth. If new orders remain under pressure and they don't get a bump, that could hurt shipments next year. And I think between now and the end of the year, you may have this weird incentive where if companies think interest rates will be lower next year, and they think if we get a change of administration, if we get a Harris administration, then you're going to get potentially higher corporate tax rates, you might have an incentive to wait to make your expenses next year because you'll have both lower interest rates and maybe higher corporate tax rates. Let's just wait till after the new year to buy stuff. So then you could have companies holding off on those purchases until after the new year. That wouldn't be great for growth in the early part of 2025.
So you mentioned the domestic political scene here in the U.S. Does geopolitical topics come up at all in your conversation with clients?
Absolutely. In every single conversation, this is a really big concern. What we've trademarked as Cold War II is something that's been going on for years. The conflict risks are accelerating. We see it in the higher oil prices going on right now, which, by the way, if the Fed is looking at the totality of the data, persistently higher oil prices, really not good if you want inflation to go down and to be able to cut rates. That's going to be really tough. So if oil prices remain higher longer, that's inflationary. And by the way, all the trade risk around Cold War II, the supply disruption risk, everything where you see container rates, how much those have risen in the last year because of what's going on with the Houthis and their terrorist harassment of shipping lanes in the Red Sea. All of those things are inflationary, and that's not good. These are part of the factors that have driven up those intermediate goods series in the PPI report. None of it's deflationary, and all of it threatens to potentially get worse going forward.
What about the tariff story?
No matter who wins the election this fall, you're going to get more tariffs, right? So I'm one of the 100 CEOs on the Texas Business Leadership Council. That is the nonpartisan, nonprofit state affiliate of the Business Roundtable in D.C. The Roundtable in D.C. is 100 CEOs of some of the biggest companies advising policymakers of both parties on non-red meat issues. Think of trade, workforce development, bipartisan immigration reform, stuff like that. So I'm one of those 100 CEOs in Texas. And we go up to DC every year, meet with both our senators, most of our congressmen, both parties, the administration, and think tanks and others. And, you know, as we have looked at these problems, we've met with the Biden administration in the past, and then we met in the Trump administration. You know, we met with both of these administrations, and there was very little daylight between the Trump administration and the Biden administration. And Bloomberg's had some great data about the tariff and trade restrictions have been put on China going forward. What happened and started under the Trump administration has continued under the Biden administration. And whatever happens this fall, the next administration will still be faced with more trade restrictions likely on China. So that trend, I think, is going to continue. That's potentially inflationary. It's potentially also beneficial for domestic manufacturing, reshoring, onshoring, also for the NAFTA region. There are economic benefits that will come with that, but I don't think we're going to wake up January 2025 and Putin and Xi and Zelensky and whoever our next president will be, Harris or Trump, they're not going to be sitting around a campfire making s'mores singing Kumbaya. There's still going to be a push for China to go after Taiwan. The coalition of the post-Cold War disgruntled is not going away and threatens to get bigger.
30 seconds. What does that mean for the U.S.?
I think for the U.S., the most important thing right now is that we have a good jobs market still. We have a lot of capital formation here. And, I think things in the economy have still been pretty good. You look at the GDP numbers, I think things are still pretty good here. And that's why even when there was market volatility over the past week, emerging markets got hit at the beginning of the month worse than the U.S. U.S. markets have since rebounded. I think this is still the best game in town. We have some of the fastest GDP in the United States of any developing and advanced economy in the world.
You sound like you're in the soft landing camp. Am I right?
I mean, I think the jobs numbers are still pretty good. We have record high payrolls. Things look pretty good right now.
All right, Jason. Always a pleasure. Thanks so much for joining us. Jason Schenker from Prestige Economics. We had some late-breaking news in the U.S. today. New York Times, the Justice Department considering a breakup of Alphabet's Google. Let's learn a little bit more as to what's happening here with our own Anna Edgerton, Bloomberg Seattle bureau chief, who obviously joins us from the city of the Space Needle. It's good to see you. How are you doing?
Good to see you. I'm doing well. How are you?
It's remarkable that we're talking about this story. I'm doing okay, but I want to know how we got here. Why are we talking about a breakup right now?
Yeah, so kind of where we are at this case is, the judge had this landmark ruling finding that Google was in fact a monopolist. And so now we're kind of moving into the remedy phase of this. So what that means is the Justice Department is going to suggest what they think the judge should, the punishment that the judge should impose on Google. Now, from people that are familiar with this case, we have found that they are including a structural remedy in that discussion. And so they are looking at several different units that could be broken off. And it would be up to the judge to decide whether or not to choose that as a remedy.
But I'm wondering if this is a little bit premature. Could the case be appealed? The decision by the federal court, could that be overturned in any way?
That's a really good question. We definitely expect Google to appeal this. Now, the question, the most immediate question is whether they will be allowed to appeal before we get to the remedy phase of the trial, or if the judge will require that their appeal wait until after the remedy is already discussed. So that is going to make a huge difference in kind of the strategy from the Justice Department and also the timeline, because if Google is allowed to appeal this liability ruling before they talk about the remedy, that could push the remedy trial out a year, maybe two. So that is a really good question.
I'm wondering from the point of view of the company, in some cases like this, where you would be betting on a change in administration, perhaps because there would be some sort of policy shift in Washington. Is that likely in this case? It doesn't seem, no matter who would be elected as president, that the DOJ would necessarily be more friendly to a company like Google. Am I wrong?
No, you're absolutely right. And this case was actually filed during the Trump administration. It was filed in 2019. And, one thing that we've written about is Trump picking J.D. Vance as his running mate definitely looks like he is, going to kind of keep a heavy hand on the antitrust enforcement. J.D. Vance has spoken favorably about Lena Khan, the chair of the FTC, who's very much aligned with Jonathan Cantor, the Assistant Attorney General of the Justice Department, who's in charge of antitrust and was in charge of this case. So, that is maybe less of a consideration for this case, but we do know that the DOJ has also filed another complaint against Google, this one looking at their ad tech business. So it could be the next administration's DOJ that ends up prosecuting that case.
So a breakup may be a little bit draconian. Are there less severe options that the company might have if they were to try to reach a settlement, let's say, with the Department of Justice?
Yeah, I mean, first of all, this is not just a punishment that the judge is going to impose willy-nilly. It's, something that would seek to address the harm that was found. So if it comes to a structural remedy, to a breakup, we're looking at units like the Android operating system, which is on 2.5 billion mobile devices worldwide, maybe the Chrome web browser, which was involved in some of the alleged behavior here, and also probably AdWords, which is the platform that Google uses to sell text ads. If we're going to stop short of a structural remedy, we're looking at things like a prohibition on the kind of agreement that Google would sign with mobile device makers to make Google's web browser and search engine the default on mobile devices. That's probably kind of the baseline that we expect the judge to accept, and then we'll see what this Justice Department asks for beyond that.
I'm young enough to remember when the government went after Microsoft. That was unsuccessful in terms of trying to find a way to get the company to maybe have less dominance in the market for operating systems and the web browser as well. Did the government learn anything from that case?
Yeah, I think they did. And I think one thing we'll see from the Justice Department and whatever remedy they suggest is that part of the argument to the judge will be, what are we going to want to enforce? Because once there's a remedy, there has to be kind of a monitoring of the company and of their behavior to make sure that they're complying with the remedy. So something like a divestiture, if you're saying you have to sell this unit, that is not something that the government has to continuously monitor because it's a business decision, something that happens. So I think that'll be a part of the Justice Department's argument in this.
So much of what we talk about around technology involves artificial intelligence, and I'm wondering whether or not that's a component in this conversation. Is it?
Absolutely. And I think, one thing the Justice Department is looking at is how dominant Google is in the current iteration on the web, and Web 2.0, let's call it, and looking at what needs to change in order to make sure that Google's not using their current standing as a monopolist to dominate the next iteration of the web, including AI. So that's where we could see some data sharing agreements, which Google says could raise privacy concerns. But we've seen this in previous cases. AT&T, from decades ago, requiring a company like Google to license or share its data with competitors so that they have access to that data to power their own search competitors to Google's product.
Good stuff. Anna, always a pleasure. Thanks for making time for us tonight. Anna Edgerton, Bloomberg Seattle Bureau Chief, helping us understand the story on Google. The Department of Justice considering a breakup of the company. One option being looked at right now, we are told. Rahul Chadha, CIO at Shikhara Investment Management, joining us on the line from here in New York City. Rahul, thank you so much for being with us. Are you generally constructive when it comes to the inflation story? It looks like a lot of the readings are trending lower.
Yeah, no, clearly, Doug, our sense was, look, things are getting softer in the economy. And here in the US, you see that. We've seen that in the commentary which came out of the March quarter and even more so in the June quarter. So the middle class, the lower middle class was feeling the squeeze. And I think the squeeze has got broadened. So that's reflected in the PPI numbers you talked about.
So in terms of what to expect tomorrow, consumer prices, are we going to get another cool reading, do you think?
I think there are large part of the kind of an index or confidence which are going to show a softer reading. Where one has seen things inch up is all this energy side or the utility pricing. So what we've seen in last 12 months as these utilities pass on higher tariffs, which is a function of them being underinvested for the last decade, that's causing an inflation. But the hope is that Fed sees through this. They clearly see that, look, the high rates have done their job, which has slowed the economy. And if they wait for too long, they risk turning this soft landing into a recession. So hopefully they come to neutral rate fairly quickly over the next 12 months.
So the bond market then has it right. If Treasury yields moved lower in New York, we've been trending down a bit. I mean, we're stable here in the Japanese session, but the bond market seems to have this all figured out, wouldn't you say?
Absolutely. I think here our sense is the yields go lower next 6 to 12 months, and probably mid of next year, then again the worry comes on the US debt, borrowing program, etc. So because those are reality, and if we are not cutting down these high peacetime deficits, and we don't have the buyers like what happened in the last 2 decades, the Japanese or the Chinese buying treasuries, we'll have another problem on hands.
I understand that, but let's focus a little bit on the macro view before we get to some of the fiscal policy and how that would influence the market. Are you in the camp that we're going to avoid recession right now?
Yeah, clearly we are at the soft landing camp, and our point is, look, if we see what Chairman Powell's been saying from last November, he was dovish, and look, our sense is he's itching to cut rates. Unfortunately, data for first 6 months was not so favorable on inflation. But as we see clear signs of softening in the economy, we've seen softening in the labor markets. People are laying off some of the temp workers, etc. So I think clearly that would give a lot more confidence to Fed to quickly come down to neutral rate. So our view is, look, unlike the past recessions, 2000, 2008, they're not large scale excesses in the economy. The real wages are still positive. The payrolls are still positive. The IIP is positive. So I think we would be in a soft landing camp. Though our sense is next 6 months may feel like an air pocket because look, the economy is coming down from a 7% nominal GDP to 4% nominal GDP. It will seem like you're hitting a stall, but it would be soft landing.
Nothing that could kind of interfere with the current environment as we get closer to that November election, though. You don't see anything, a meaningful downshift between now and then, do you?
See, unless or until the things or the situation in Middle East escalates significantly, or unless or until we have whatever Fed deciding to wait for more data, then it may just risk pushing the economy or tipping it over into recession. So it's like getting whipsawed on both sides that they missed on inflation, and then when things were slowing down, they waited too longer.
So let's go back to politics and address the issue that you brought up earlier, which is the deficit here. And I think we're looking at something through the end of last month, I should say, July, at around 1.5 trillion. That's a big number. And the number on just debt service, I think, was over $900 billion. I mean, it's staggering when you look at kind of what's at stake here. If those Trump tax cuts are allowed to expire, assuming that we have a new administration that would allow that and maybe a configuration in Congress that would support that, wouldn't that be a net positive for the deficit?
Maybe somewhat positive, but look, we don't get signs from the Democrats also that they're looking to significantly bring down deficit. And I think that has a risk of crowding out. Look, you've got all kind of estimates over there that close to 20% plus of the government revenues will go towards interest payments. So clearly that has a fair bit of a crowding out effect. That has a fair bit of a fiscal drag coming in the coming years.
A lot of what we focus on this program, Rahul, has to do with Asia. Let's talk about China right now. This economy seems mired in deflation and subpar growth. I doubt very much, at least in the view of the people that we speak with frequently here, that Beijing is going to be able to reach that 5% growth target. Would you say that's a fair bet that will fail, or China will fail on that front?
Yeah, I think numbers are going to be soft. See, what we've seen is anytime large scale excesses happen, whether it's a story of Japan, whether what happened in US in the 2000, it takes time. So what we've seen price correction in the Chinese stock market happen. What we need is time, and time typically is 5 to 6 years for those excesses to be digested in the economy. So that's where somewhere those excesses are digested. So growth is going to be slow, but what we are looking in China is this margin resilience, which is going to come through. What you've seen, competition is significantly over last couple of quarters. So what is visible in the leading companies in China is somewhat this pricing power, somewhat this margin resilience. These guys are doing fair bit of buybacks, dividend payouts. So obviously one has to moderate return expectations. But look, the sentiment is very negative. It's almost at a panic level for China. And typically what we've seen is those are good entry points because the expectations are low. And won't be surprised if some of the leading Chinese companies give us 15 to 20% returns in 12 months from now.
So panic maybe where markets are concerned, but I think we can agree lackluster sentiment where consumers are concerned in China. And I'm wondering whether that creates a risk of sustained deflation and a trap that is not unlike what happened to Japan more than 30 years ago.
So I think what you've said here is a fair point, and that's a risk everybody is watching closely. And which is why when we look at China, what we're playing is this value maximization story. We've kind of looking at the local Chinese company, which are offering a superior value proposition to the consumer and gaining share from the multinationals. We are playing the global champions from China, companies which are making inroads globally, the likes of Pinduoduo or the BYDs, etc. But I think the Chinese government is aware of that, and which is where what you see in last 1 or 2 months is they're using more of the central bank's balance sheet to give this fiscal handouts. So in the past, it was left to the local governments. Look, they realize that local governments don't have much revenues now because the land sales have plummeted significantly. So clearly, the onus is now on the central bank to kind of expand this firepower of incentives. And they're moving in the right direction. They want to get the animal spirits both from a business and consumer back. And clearly, it's going to take its own sweet time. It's going to take a couple of quarters before things come back. And look, they're not going to go back to the times we saw 5 years back. China is not going to go back to 10 to 12% nominal GDP, but 7 to 10% should be a good number in next 2 years.
Before we let you go, Rahul, the situation in Japan, I mean, we saw what happened in markets as a result of that yen carry trade unwinding. We know some of this has to do with the Fed, to be sure, but we can't ignore the fact that the DOJ has made a pivot in terms of its monetary policy. 30 seconds. What is your outlook for Japan going forward?
Clearly, I think the market offers value. And as investors get confidence on the soft landing and the Fed easing coming through, they would be interested in the market. It was just that it was such a crowded trade, like both by the quant funds and the big pods. And both these parties who account for 50% of the market turnover have limited risk appetite. So when everybody was rushing for the door, suddenly people realized the door was way too narrow for everybody to exit at the same time.
Boy, that is so true. Rahul, thank you so much for joining us. A great conversation with Rahul Chadha, CIO at Shikhara Investment Management. This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.